Foreign portfolio investors offloaded 85,790 crore rupees in Indian equities as of October, marking the highest sell-off in 10 months. The net outflow stands at 89,977 crore rupees. This drastic shift came as FPIs turned net sellers, influenced by geopolitical tensions and the lure of cheaper valuations in Chinese stocks. Following a robust buying spree in September, the focus has shifted, raising questions about future market stability. This raises important questions. Should retail investors also consider investing in Chinese or other international stocks? There are compelling reasons to explore global markets. First, diversification benefits. Investing internationally spreads risk and reduces the impact of poor performance in a single market. Different economies experience varying growth cycles, so when one slows down, another might be thriving, offering fresh opportunities. Additionally, investing abroad grants access to specific growth sectors, such as technology in the US or commodities in Australia, which may not be as prominent in one's home country. Emerging markets, like China or India, present high growth potential compared to mature economies, allowing investors to capitalize on rapid expansion. Investing globally also acts as a hedge against currency depreciation and domestic inflation, providing exposure to different currencies. Finally, political and regulatory diversification helps protect investors from country-specific risks, adding a layer of stability to their overall portfolio. However, we should also consider that the Chinese market has underperformed compared to the Indian market over the long term. According to a Deutsche Bank report, since 2000, India's equity markets have consistently outshone China's. Despite China's impressive economic growth, its equity markets' real returns have averaged only 4.0% per annum. In contrast, India has emerged as a top performer, delivering one of the highest real equity returns worldwide, at 6.9% per annum. This places India among the leaders across both emerging and developed markets. The report emphasizes India's strong growth trajectory and potential, making it an attractive destination for investors. While China may present certain opportunities, India's proven track record of high equity returns makes it a compelling choice for those seeking long-term market success. For those considering investing in Chinese stocks, there are several options available. First, you can explore China-focused mutual funds and ETFs, such as the Edelweiss Greater China Equity Offshore Fund or the Nippon India Hang Seng BIS ETF. These provide diversified exposure to Chinese markets. Another way is through the Liberalised Remittance Scheme, LRS, under which Indian investors can remit up to $250,000 annually for direct investments in Chinese stocks or ETFs listed internationally. Finally, investors can open international brokerage accounts. These accounts grant access to Chinese markets but require careful consideration of fees, currency risks, and regulatory compliance. Each of these options offers different benefits and potential risks, so proper research is essential. If we consider the option of investing via China-focused mutual funds, there is one fund named Edelweiss Greater China Equity Offshore Fund. First, the fund has a high expense ratio of 1.4%, significantly above the category average of 0.52%, which could impact your net returns over time. Performance-wise, the returns have been mixed. In the short term, the fund struggled, with a 6.48% loss over 1 month and a 5.92% drop in just a week. While the fund delivered 11.77% over 3 months, its 3-year performance stands out for the wrong reasons, with a minus 24.49% absolute return and annualized returns of minus 8.91%. Overall, while it has seen some longer-term success, the inconsistent returns and high costs make it less attractive for risk-averse investors. Now, let's discuss the Axis Greater China Equity Fund of Fund Growth. This fund has a high expense ratio of 1.57%, exceeding the category average of 1.06%, which can erode investor returns over time. Looking at performance, short-term results are concerning, with a 7.28% loss over the past week and a 6.32% decline over 1 month. While the fund did generate a 10% return over 3 months, the 3-year performance is poor, with a -17.50% absolute return and -6.19% annualized return, ranking near the bottom in its category. The performance since inception is also negative, with a -27.40% return, reflecting the fund's overall volatility and underperformance. This highlights the risk associated with investing in such high-expense funds. Before investing in international markets, it's essential to consider a few critical factors. Market risks are significant, including currency fluctuations, geopolitical issues, and varying market regulations that can impact returns. Regulatory compliance is also crucial, as investors must adhere to guidelines set by the Reserve Bank of India and other regulatory bodies. Finally, thorough due diligence is necessary to understand investment vehicles and underlying assets before committing your hard-earned money. Please note, this analysis is for educational purposes only and not financial advice. Always do your own research before investing.